A comment by President Donald Trump in an NBC interview that aired yesterday has raised some eyebrows now. In reiterating his stance against cheap Chinese goods, the president said little girls could do with 3 or 4 dolls instead of 30. Now, he said he wasn't saying that there would be mass shortages for American consumers, but rather that he's just trying to target the U.S. trade deficit with China. He also made a similar comment during a cabinet meeting last week. Now, Joining us now is Daniel Lacalle, chief economist with Tariffs and author of Freedom or Equality. Daniel, thank you so much for being on. Always great to have you on. So let's talk about this, all right? The president, he makes the statement during this interview. He made a similar statement in a cabinet meeting earlier on. It's caused debate from all sides here. You know, we've got some economists, they're saying this goes against free market principles or is nanny statism. Is that a concern to you?
Of course, it's not a concern. And of course, it's not nanny statism and certainly doesn't go against free market. What he's basically saying is very simple, is that an economy in which consumption is the number one driver, there can be elements of adjustment in which the benefit for the overall economy, for everybody, for families, for businesses, etc., may come from being a little bit more prudent about consumption. Think about what he said. He said they don't need to have 30 dolls. They can have 3, 4, 5. That's basically what he is saying, is that the United States cannot compromise all of its economic benefits and strengths just because it needs to import all and any Chinese cheap good. No, there are lots of things that can be done, including improving the relationships with China in order to level the playing field. That's what he's saying, and he's given a very logical explanation. Maybe there may be some increases in prices of a very specific type of toy, but there's not going to be an inflationary pressure, and there's not going to be a shortage of goods for families and for businesses either.
Daniel, to your point there, we also see the president ending the de minimis rule. Now, Americans, they've gotten used to getting this cheap, readily accessible goods. Do you think Americans are going to have to go through some sort of a paradigm shift in consumer culture here if they're going to adjust to a new reality?
I don't think that Americans need to adjust to a new reality, just to the reality. The reality is actually evident in what Americans are doing already, which is the American consumer is a very strong consumer and is willing to accept cheap goods reasonably well, but is not willing to accept any good at any price. And I think that that's what what President Trump is referring to, is that there may be a little bit of an adjustment in terms of, instead of having hundreds of thousands of different things to check, and many of them actually look at the amount of all those products that end up in garbage cans, is that we may have to look for things in a little bit more prudent way. But that's not saying that that consumption needs to be drastically changed, or even worse, that has absolutely nothing to do with nanny statism. Nanny statism is what we have in the European Union, by the way.
All right, so on the point of de minimis here, Daniel, we saw Temu in response to this de minimis cancellation. It says it's going to cease shipments to the U.S. from China. It also says that it's shifting to this local fulfillment model. Tell us more. What kind of a shift are we seeing here?
There's no shift. It's just rhetoric. What we're seeing is a narrative, trying to build a narrative that all of the tariff negotiation and all of the commercial trading, balancing policies of the Trump administration are going to be negative for the United States and excellent for China. Look, today the Financial Times is taking the headline of Chinese exporters looking to wash origin out of their products in order to continue to sell to the United States. So the idea that Chinese companies are going to basically find the same way to sell their products outside of the United States is already negated by the reality of having ports in which containers are piling up with no ability to sell them. And number two is that they are washing origin, as the Financial Times is suggesting. So, no, I don't think that there's going to be any of that. Right now, a lot of countries that have had a very, very easy ride with the United States, China in particular, are trying to say that they are not going to negotiate anything and that they are not going to get into deals with the Trump administration. We will see those deals very, very quickly. It's pretty evident in the working capital challenges of many of these exporters.
All right, Daniel, then respond to this concern here. The president, we've also heard him say he wants to target non-tariff trade barriers, right? So these are things like agricultural safety requirements, red tape at borders, currency exchange rates, and this is just to name a few. Now, some are concerned that this is going to end up becoming excessive government control once again over the market. How do you respond?
I find it so. Sorry to laugh. I find it so funny to hear that there are some economists saying that what Trump is doing is nanny statism and market interference, when what we live in the European Union and in China is market interference, and they have said nothing for decades. Now, I think that what we need to understand is this is a very, very simple situation. It is simply leveling the playing field. And what we're talking about right now is simply a situation in which the United States is not looking to tamper with market forces. It's trying to let market forces actually work. Because right now, the level of intervention of states in those elements that you just mentioned, but in so many others. For example, the European Union, for a U.S. exporter, exporting to the European Union, receiving a license may take up to 5 to 7 years. That makes no sense for a U.S. company. It's not a third world nation. No, the so-called environmental requirements, to add insult to injury, they're imposed on U.S. companies, but they exempt Moroccan and North African companies from those requirements. So there's a lot of hypocrisy right now. And one of the things that I've been writing about recently is that if all those economists had mentioned at least once in the past 10 years all the enormous trade barriers that were rising in the nations that trade with the United States, today we would not have this trade negotiation problem. It would have been a lot more positive for everybody. And think about this. The things that the Trump administration is talking about, the non-tariff barriers, particularly in the European Union, those are the same things that the Mario Draghi, ex-ECB president, chairman report mentioned. Those are those internal barriers that the European Union puts that lift prices in the European Union by up to 110% in the services sector. So ultimately, this doesn't make any sense. All these comments that you're referring to, because what these economists are actually doing is being incredibly hypocritical about the enormous trade barriers of other nations, and basically trying to tell everybody that it's the United States as if we lived in some sort of free trade paradise until February 2025. No. The norm in the world is that we live in a world in which the amount of trade barriers, non-tariff and tariff barriers implemented by most of the US trade partners are enormous and have been rising in the past decade.
All right, Daniel, before we go here, let's take a look at China, right? We're seeing growing numbers of these factory owners, of these business owners saying that they're struggling to stay afloat right now. They're struggling to keep their workers employed. But we're also seeing by June, there's going to be a whole new influx of millions of fresh college grads in China who are going to be flooding this workforce and looking for those jobs. We're also hearing analysts saying that the current barriers, if you will, that the Chinese regime is putting on the rare earths trade, it's only going to end up shooting the Chinese regime in the foot in the end. Based on everything we're seeing here, Daniel, are you seeing any indication of which way the Chinese economy is headed right now?
Oh, look at the latest PMI figures, the official PMI figures. They're plummeting. Yeah, the manufacturing PMI is in contraction. And if the official Chinese PMI is in contraction, that means that the manufacturing sector in China is really struggling, really struggling. And you have mentioned something that is very important. A lot of these companies were already in challenging situations prior to the trade negotiations. They were already witnessing a rise in delinquencies, increased bankruptcies. The corporate bankruptcies in China were rising to new highs already in 2024. All these things are important precisely for what you just said. A lot of graduates are coming back to China, and the country needs to find jobs for those people in an environment in which companies are doing what they can to keep the existing workforce, which in many companies is a much higher workforce than an equivalent company would have in the Western world. Because, as you know, many Chinese companies, they employ a lot more people than what they actually require, because they get quite a few levels of support from the government. Right now, working capital challenges, delinquencies, and also bankruptcy problems are piling up, just as an influx of a tremendous number of new workers are coming into the Chinese economy. That means that there's a big risk for an underemployment problem similar to the one that, for example, Japan had in the early 90s.
Well, Daniel Lacalle, it's always great to have you on. Thank you for coming on. Happy Monday.
Happy Monday as well. Thank you very much for having me.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.